SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Ladies and gentlemen, welcome to this SUERF Baffi Bocconi e-lecture on the international role of the euro, state of play, drivers, and prospects. My name is Ernest Gnan. I'm head of economics at the Österreich National Bank and SUERF Secretary General. We have 5 excellent speakers today with us to shed light on this interesting topic. To start with, Hans-Joachim Klöckers, Director General of International and European Relations at the ECB, and Arnaud Mehl, Advisor at DG International and European Relations from the ECB, will present this year's report on the international role of the euro. Then Klaus Wiedner, Director at FISMA B, European Commission, will present on the international role of the euro and the EU strategy to foster openness, strength, and resilience of the European economic and financial system. Subsequently, Harold James, professor at Princeton University, will give his take from a more historical, broader perspective. And to conclude, Bob McCauley, non-resident senior fellow from the Global Development Policy Center in Boston University, will focus on the competition between the euro, the US dollar on the one hand, and the Chinese renminbi on the other hand. Without much further ado, I hand over to Hans-Joachim.
Thank you very much, Ernest. So, as you mentioned, Arnaud and myself will present the latest report of the ECB on the international role of the euro. This is the 20th such report, so it has already a long tradition. But I think it's fair to say the public attention to this report has been increasing a lot in the last couple of years. And we see increasing political momentum in this debate. We had a Euro summit, so a summit of the heads of state and government of the 19 countries who have the euro in March, who issued a statement support strengthening the international role of the euro. The ECB president gave a presentation there, and we have seen a lot of debate afterwards. The structure of the presentation is rather straightforward. I will start with a short summary of what happened last year. Arnaud will then present 3 special features we have included in the report. One is related to the policy responses to the pandemic and the impact on the international role of the euro. The second is on CBDC, global currencies, and the third is on some new research on invoicing in global trade, and then we conclude the presentation. Starting with the overview, you have 2 time series here, one constant exchange rates, one current exchange rates. They both have the same pattern. I mean, what we do here is we construct an index of different indicators of the international use. And it's a clear picture. We had a very strong start of the international role after 1999. And then at the latest, after the global financial crisis, 2009, there was a rather steady decline until 2016. And recently a bit of a stabilization, but still at low levels. We attribute the decline since after 2009 to a large extent to the fears of sovereign debt crisis, fears of also instability of the eurozone as such, and we take it as a positive message that in this last year, in 2020, we didn't see a dramatic decline as we had seen it last time. So if you look at the 2020 numbers, you see the yellow line is more or less stable. The blue line is slightly down. I mean, the yellow line is current exchange rates. The blue line is constant exchange rates. The euro has appreciated last year, and that's why explains why the two lines don't show exactly the same, but we interpret this as a broadly stable development, and we consider this as much more positive than what we have seen in the last crisis. And probably one of the main lessons of last year is the euro area has seen a rather forceful policy reaction, and a more forceful policy reaction than we had in previous crises. The most important element was the NGEU package, the fiscal framework, which includes grants across countries, but also the ECB measures helped. They were swift and of large size. So we didn't see any discussion last year of a breakup of the currency union, and no flight out of the euro, which we consider a step forward. And Arnaud will later go more into details on this. But it's clear also from this chart, no, we are still at a low level, almost the same level as we were at the beginning. And there need to be much more reforms in the euro area in order to make the euro more attractive for international investors. Now, looking at the picture across different indicators, this is a picture is almost unchanged every year. I mean, you see the euro is the #2 currency on all scores after the US dollar, but far behind the US dollar and far ahead of the Japanese yen and the renminbi, which are in red and green. The only exception is payments data, but these are largely linked to trade invoicing. There's a lot of trade with the euro area. The euro area is a relatively open economy. That explains why we are higher on the blue scale. If you go to the next slide, you see here nicely that the US dollar punches above the global economic weight of the US economy. So if you take the chart on the left, on the x-axis, you see the index, which we had in the first slide, so this long-term time series. And on the y-axis, you see global GDP share. And you see here you have the international role of the dollar is above 50%, while the share of the US in global GDP is just around 15%. So far, the US dollar share is far above the US share. When you look at the euro, we have 20 against 12. So also the euro is above its economic weight, but to a smaller proportion. You see that for the Japanese yen, it's more or less the same. It's on the 45-degree line. It's 4%. Well, for China, you also see that the international role of the renminbi with around 2% is far below the weight of the Chinese economy in the world, which is 18%. And on the right-hand side, you see the same where you compare to trade, share in global exports of goods and services. The picture is essentially the same. US dollar far above global trade, the Chinese renminbi far below, the euro slightly above. So this picture, I think, shows nicely that there is potential for the renminbi to catch up. It is positive on the role of the euro insofar as it shows that we are in principle higher than our own economic weight, but we are far away from the US dollar. Now, looking more closely at what happened in this year and focusing on the indicator in constant exchange rates, we have on the left side a couple of statistics which have slightly decreased in the international role of the euro. You see deposits, foreign currency debt issuance, foreign exchange reserves, all slightly down. But you also see on the right side the euro exchange rate appreciated quite significantly, which kept the index in current exchange rates stable. I will now in the next 3 slides look a bit at the 3 red bars here and try to dig deeper what happened. So if you look at deposits, which is this slide, we think what we have seen here is a dash for cash. After the pandemic, there was a strong desire to of all investors to have US dollar liquidity. So there was a lot of US dollar hoarding. Credit lines in US dollar were used. They were put into US dollar deposits. And that is essentially what we see in this slide. That also affected the euro downward, but this is in terms of shares. So we think this is a typical sign of the pandemic reaction. When we look at the foreign currency bond issuance, our interpretation is that after the first period of COVID, there was a lot of reduction in risk aversion and positive risk sentiment. Again, there was a large issuance of international bonds by emerging markets, and emerging markets traditionally issue bonds in US dollar. So they have traditionally a higher weight of US dollar bonds than euro bonds. And so in that respect, you have a kind of composition effect of the debtor structure, which benefited the US dollar last year, as you see on the left side. So the slight increase is very much attributable to the rise in the issuance of emerging markets. And in foreign exchange reserves, which is the next slide, if you start from the left, you see here a clear downward trend of the US dollar since 2008. But you also see a clear upward trend of the red line, which is third currencies since 2008. And these are a mix of currencies like British pound, Australian, Canadian dollar, but Japanese yen and renminbi and others. These are the longer term trends. When you look at 2020, you see that the US dollar remained at a historical low. The euro was very slightly down last year, but it has been a rather insignificant shift. And on the right-hand side, you see one reason why the euro, of course, is still not the most attractive currency for reserve managers. This is the negative interest rates, which offer disadvantage for investors at first sight when they make their choice. But it's obvious the trend for diversification of reserve assets continued last year, as you see in the red line. Now, one further slide on ongoing developments. This is the green bond markets. Here you see on the left-hand side, this is the global issuance of green bonds. So this is not the international issues, which is right. So it's all issuers. You see the share of the euro is slightly above 50%. So it's pretty significant. Of course, this is partly issuance by euro area residents, but you also see on the right-hand side, when you just look at foreign, so non-national issuers, the share of the euro is exceeding 30%. So it's far higher than the normal share, which we have, which is around 20% in international bond markets. So we see here a rather strong increase in the international role since 2016. We also think there's a high potential to foster here the international role of the euro by developing green markets in the EU, which can meet the highest standards of investors in terms of regulation, but also which are sufficiently deep so that they have enough liquidity and allow for efficient pricing. So that concludes my first part. So to just summarize, so we see a broad stability after the pandemic shock. We think this is a positive development compared to the last crisis. It reflects a forceful joint policy response in the EU this time, but we also should see that the average share of the euro across various indicators remains historically relatively low and well below the pre-Lehman peaks. And we see, fourth, the global trend towards reserve currency diversification continuing, and a role for the euro to strengthen its international position in green bond markets. I'll pass on to Arnaud.
Thank you, Hans-Joachim. So like Hans-Joachim said, I'll talk about the special features. This year's report, we have this, what we call the full-fledged report. I'm sorry? So this year's report, we have the full-fledged report in a sense that every other year we write an interim report, whether it's just a statistical update. And in the remaining years, we write a report which is richer analytically and has special features and analytical boxes, and that's the case this year. So this year we have three big special features. The first one is on the EU and the ECB policy responses to the pandemic and the euro's global role. Last year was the year of the pandemic, so we wanted to write something about this. The second special feature is about the central bank digital currency and global currencies, which is also a topical issue. And the last special feature is on the euros and invoicing currency for global trade, which is more like a secular topic, which is always important, and which we think we made progress this year, and I'll talk about this in a second. I won't be very detailed because we don't have much time, but I try to come up with the main bottom lines about each project in the rest of the presentation. So the first special feature reviews how the EU and the ECB policy responses to the pandemic were relevant for the international role of the euro. And in particular, that special feature elaborates on the implication of next generation EU, so one of these important initiatives which were taken last year, and sure bond issuances mattered for the euro's global role. If you focus a second on the chart on the left-hand side, what you see is evidence of strong interests in sure bonds from investors outside the euro area. These are the yellow bars that you see in the chart. And what's important as well is that foreign investors were especially attracted by shorter maturities. And this you see on the table on the right-hand side. And that reflects the stronger presence of official investors in that segment. So for instance, for the sure bond 5-year maturity, you had a share of non-EUR investors of 60%, which is twice higher than the sure bond with 30 years maturity that was issued, which has a share of roughly 1/3, 35%. Now, NGU bond issuance is quite important for the international of the euro for at least two reasons. First, it's a steps toward establishing a common European safe asset. And second, there is a link to structural reforms in NGU, in next generation EU, which should increase the resilience of the euro area to future shocks and alleviate market concerns about the fragility of the euro area. However, and here's a nuance to that overall assessment, it's quite apparent that NGU remains relatively modest in size when you compare what it is compared to bond markets in other major currencies. And you really see that on the chart on the left-hand side, where you see the outstanding of general government debt securities in the main markets around the world, in the US, in Japan, China, in the UK, and also in the euro area, where we consolidate all the debts of euro area sovereigns and add NGU and sure issuance on top. And what you see is that even after accounting for planned NGU and sure bond issuances, it's clear that US Treasury markets dwarf in scale euro area government debt securities markets. And on top of that, and this is something which is apparent on the chart on the right-hand side, the size of highly rated, so AAA rated, debt securities in euro is about 3 times smaller than that of debt securities highly rated or AAA rated in dollars. So they account respectively for 5% of our GDP compared to 15% of our GDP. And that again shows that these are things which are different order of magnitude. And finally, that's perhaps a last important thing to note. So this initiative, Next Generation EU, is temporary. It has a long period, but it's temporary. And for all these reasons, down to the bottom, it's therefore unlikely that at this stage it will fundamentally change the global status of the euro. It's a positive step, but it's unlikely to be an enormous game changer. Turning to the ECB now, the ECB's monetary policy responses in response to the pandemic have been swift and forceful, and they have helped to stabilize the euro economy, and that also indirectly supported the let's say the attractiveness or the appeal of the euro globally as a currency. We had the launch of our pandemic emergency purchase program in March 2020, so just after the outbreak of the pandemic, with an envelope which was initially set at 750 billion euros, which was almost triple at the end of 2020. We had the expansion of what we call TLTROs, so targeted long-term liquidity refinancing operations, which now have a volume of which is roughly close to 2 trillion euros. And we had other measures to increase the attractiveness of those TLTRO measures. For instance, we cut the lending interest rates to -1%. We had the increase in the borrowing allowance, and we make the range of eligible collateral that you can pledge against those refinancing operations a bit broad. But what's interesting from an international perspective is that we also reactivated liquidity lines and established new lines with foreign central banks. When I talk about liquidity lines, what I mean is our swap line operation and repo operations, which we have with foreign central banks. And you see how these things work on the chart on the left-hand side, which is a schematic representation of how the euro system framework for providing euro liquidity to other central banks work as far as swap lines and repo lines are concerned. We also set up a new facility, which is called EUROP, the Euro System Repo Facility, which allows to provide euro liquidity to a broader range of non-euro area central banks. Those measures, all in all, helped us to fulfill our monetary policy objectives. For instance, it prevented euro liquidity shortages, which we could see outside the euro area from morphing into financial stability risks. It avoided forced asset sales and negative spillback effects back onto the euro area, which could have originated from the use of the euro by non-euro residents as a funding and or investment currency, and down to the bottom could have posed risk to price stability in the euro area itself. Now, the liquidity lines that we have provided have been drawn sporadically and for relatively small amounts. However, and that's the signaling effect of the availability of that instrument, the fact that they were just available have been in itself successful in, or let's say, contributing to mitigating stress in euro funding markets overseas, especially in economies with strong economic ties with the euro area. And we did a simple invest study to quantify that effect in the report, which suggests that indeed, when you look at announcements of liquidity arrangements during the pandemic with non-euro area countries, those announcements did help reduce the cost of funding in the economies concerned. When you look at the evolution of what we call the currency basis, so that's essentially the cost of swapping a local currency into euros to get synthetic funding in euro. And you did have a significant decline in the cost of getting such funding in euro, synthetic funding in euro in those countries concerned by an estimated 20 basis points in the following 2 weeks after an announcement. So quite a significant reduction in the cost of funding of the recipients, which made the euro an attractive funding currency for those countries. Okay, the second special feature is about central bank digital currencies and global currencies. Now, issuing a digital euro, which is something that we're pondering about whether to do or not, and we had the report on digital euro which came out last year, and now we're in the process of evaluating whether or not we should embark on a project like this. That would not be only important for the euro area itself, but it would be important for us, in particular, if a global or euro stable coin, or even a foreign central bank digital currency, were to largely displace existing euro means of payment. And in the future, if we go ahead in the euro system with that project, we will have to discuss whether or not cross-border use of the digital euro should be possible at all. Now, if this were to be the case and we were to make that decision, a well-designed digital euro could preserve the role of the euro both in domestic payments, but also it could contribute to enhance the global attractiveness of the euro across borders, by, for instance, reducing frictions and cost of making payments in euro cross-border. What the special feature does essentially is to discuss the particular features that would be specific to digital means of payment that could ease international adoption of the digital euro and central bank digital currencies in general. And it reviews a number of features that are specific to such means of payment. And for instance, the fact that they are safe, that they have low transaction costs, that you have bundling effects, that they can be paired with attractive services, and that can be programmable. The special feature also stresses that design choices matter for the global outreach of a CBDC. And among the design choices that we discuss in the report, you have the fact that whether or not the digital euro central bank digital currencies will be interoperable with each other, whether there are restrictions on quantities, whether there are holdings to limits to non-resident holdings, or whether there are restrictions on the remuneration of the CBDC, so price restrictions on the CBDC remuneration. We also did some simulations to illustrate the main impact of the economic forces at play when trying to understand the international implications of a CBDC on the global role of the euro and international currencies. And this is what you see on this chart, where we show the impact of the creation of a CBDC, of a central bank digital currency, on the currency composition of global export payments through the lens of a model. Now, the chart contrasts two model simulations. There is a baseline simulation without a central bank digital currency. That's on the left-hand side, or left-hand bars. And there is another simulation where one of the countries in the model, there are three countries in the model, but think of it as, let's say, the US, the euro area, and China. But so one of these three countries issues a CBDC, and we try to estimate how, or simulate how this impacts the currency composition of global export payments. Now, in the baseline simulation, the one without CBDC, the country one's currency, we could think of it as, let's say, the euro area, accounts for more than 60% of global export payments in that particular calibration of the model. And you see that on the left bar, the left blue bar of the chart. Now, if this country issues a CBDC, so if the euro area were to issue a CBDC, the share of its currency would increase further, and you see that in the right blue bar of the chart. But the economic magnitude of the increase is relatively modest. In this particular simulation, it's just an additional 5 percentage points compared with 60% at the start. So therefore, and that's perhaps more than the quantitative estimate, it's more the qualitative conclusions that are important. What we learned from this model simulation is that the role of currency in global export payments depends much more on fundamental factors, such as the size of the economies, the stability of their fundamental, than on the availability of a central bank digital currency or not. That helps at the margin, but that's not the main factor. The main factor are fundamental forces, the soundness and the size of economic fundamentals. Okay, the last special feature is about the role of the euro in global trade invoicing. And it builds on a joint project that we did in the ECB with colleagues at the IMF, where we developed a database on patterns in global trade invoicing. And the special feature comes up with a number of conclusions. Some are new, some are not new, but provides a further evidence of something which we know with better data. And one thing that we find, which is a confirmation of past results, is that the dollar in global trade invoicing plays a disproportionate role. And you see that on the left-hand side chart, where we compare the share of countries as export to the US in total exports with the share of their exports invoiced in dollars. In almost all cases, all countries in the world use the dollar much more than they trade with the US. There is really a disproportionate role of the US dollar compared to the share of the US in countries trade. So that's something which we knew. But the special feature also points to several new facts. So for instance, it shows that the euro is more important than the dollar as an invoicing currency in some regions in the world. So that's something which we didn't know and that we show here for the first time. And that's visible in the chart on the right-hand side. From a global perspective, when you look at all countries in the world, the euro share in trade invoicing aligns much more than the dollar with the share of the euro area in countries trade. So countries scatter much more around the 45-degree lines for the euro than they do for the dollar. However, there are some exceptions. And for instance, you have a bunch of countries in non-euro area Europe, so Eastern European countries and also African countries, which are on the top left corner of the right-hand side chart, where those countries use the euro much more than their exports to the euro area. And you also have some countries which use the euro much less than what their exports to the euro area would predict. I see, for instance, that Russia or Kazakhstan or Azerbaijan and Algeria use the euro much less. And that's the reason is that these are countries which essentially export oil. So we know that oil is essentially invoiced in dollars, and those countries then use the dollar, even if they export that oil to Europe. Okay. Now it's time for us to conclude. So there are essentially three broad conclusions that we can take from this year's report. The first conclusion is that there has been broad resilience in the role of the euro internationally, despite the pandemic shock. And that's quite noteworthy compared to the summer debt crisis episode of 10 years ago, where the fall of the euro, the fall in the attractiveness of the euro's international was much steeper. That development suggested that something was different this time, and what was possibly different was the fact that you had an effective and unprecedented policy support set of measures and a coordinated approach that prevailed in the euro area. However, and looking at things from a long-term perspective, there is still stability of the euro at a low level, and that suggests that only further resolute policy measures and reform efforts will enable to realize the euro's global potential. In a presentation like this, it's also good to stress what the policy implications that this could have. One thing which is important to us is that the policy implication which we stressed in the past remain essentially valid. We stress that in fact the resilience of the euro area should be increased, and one way to do that, and perhaps an important way to do that, is through deeper and more complete economic and monetary union and sound policies. Also, the fact that euro area capital markets are less deep and liquid than the US, as we try to document in the report, suggests that progress towards capital market union is something which is also important. There were other positive factors that we noted throughout the report for the euro's role, for instance, the creation of next generation EU, which is a step towards creating a common safe asset. The fact that the euro has potential in global green bond markets, which suggests that setting global standards and deepening green bond markets in the euro area could also play out favorably for the euro's international opinion down the line. The work on the digital euro is still in early stages. It probably will play a positive role to make the euro more attractive internationally. But however, what really matters are sound fundamentals and the fundamentals of an international currency rather than just the digital euro. And at the end of the day, the international of the euro will continue to depend on sound economic fundamentals, sound policies, and deep and liquid capital markets. The secret sauce of an international currency still has the same ingredients. All right. Before I conclude, it's probably tempting to also turn to history because history is always, and I guess that Bob McCauley and Howard will not contradict me, always insightful to look at, to meditate about the present. And indeed, when you look at history, it probably offers some important lessons for the euro today. That chart shows the currency composition of global foreign exchange reserve over the past 120 years. The data are arguably very patchy. It's the outcome of many years of research, which we did with academics over the past 10 years. However, this patchiness, they are still instructive because they do suggest that sterling was the main global reserve currency before the First World War, while the dollar played absolutely no role. While a few years later, after World War I, the shares of dollar and sterling were comparable, and after World War II, the dollar had dethroned sterling quite quickly. Now, what were the main drivers behind these developments? The thing which is often lost in translation is that policy and reform efforts were in fact important for the rise of the dollar as a leading global currency. Of course, and that's what people immediately think about, the two world wars were important. They weakened the British economy and the city of London significantly to the benefit of the dollar. But policies and reform efforts in the US matter too. For instance, the creation of a lender of last resort like the Fed in 1913, or the role of the Fed in the market for dollar acceptances, were among the policy and the reform efforts that helped in the dollar's ascent to supreme status in the international currency sphere. And likewise, by pursuing the right policies and reform efforts, we can realize potentially the full potential of the euro as a global currency in the next years ahead. And with this, I will conclude. Thank you.
Thank you, Hans-Joachim and Arnaud. We now switch over to Klaus Wiedner. Klaus, over to you.
Many thanks, Ernest, and many thanks for the invitation. Now, for a long time, we've been in a world where we all thought multilateralism will work and there's the rule of law and everything will be fine and everything, we're very export-oriented, obviously, as Europe and the EU. And then, as you all know, there were incidents, especially during the last years, which made us doubt that actually that's really the case, and we can rely on this multilateralism to continue forever. And you remember there were a few things. There was Iran. I'll come back to that maybe later. But a few issues which made us doubt that this system will actually continue working as it works. And we can see that it's a bit of the question of Europe in the world, obviously seen through the lens of financial system, but obviously there's a broader debate going on beyond financial. On the one hand, obviously US, our key partner. At the same time, we see now that there's a lot more US engagement again, which I think is very good, and looking forward, we hope that it will continue like that. But at the same time, there are pressure points that remain. Just mentioned Nord Stream 2, but there are others as well. So just a thing that we have to follow through further. Then we see China getting more and more assertive on the international stage. Obviously, the pressure that we get from China is less through the financial system because their financial system is less developed than the American one. But still, it's something to be reckoned with in the future. And then obviously we have more far closer to home. We have the Brexit and withdrawal of the UK from the EU, which has its own issues on strategic autonomy, and they're also very much including on financial services, for example, on clearing. But I'll come back to that later. So if you turn then to the currencies overall, which is I think is part of it, and then I think I can be quick because the ECB said it already. I think we have a system that is overly dependent on the US dollar, but it's something that is gradually changing to the benefit of the euro, but also to the benefit of many other currencies. So we're getting a bit multipolar, but that's also Australian dollar, Japanese yen, Canadian dollars, and others. And obviously for us as the EU, we would like to have a better role, a bigger role of the euro internationally, also for economic reasons. Transaction hedging costs will be reduced, but also for financial stability risks to go down, because obviously we're very dependent on the dollar. We've seen that in the financial crisis, and that obviously has also a number of risks. And then the latest obviously background element that we have is COVID-19. Which emphasized again, and I think it's going beyond the financial system, vulnerabilities that we had, for example, in critical chains and value chains and services, and that's obviously showed us that we have to be overall financial system, but also broader. I think we need to look into this autonomy angle again. So turning to the financial system. This one, yeah, thank you. So, I mean, to be very honest, there's always a big debate that we have within Europe. Yes, but we're multilateral, and we want to be multilateral because we benefit from the exports. With the big exporter here. On the other hand, I think we need to make sure at the national level that we also respected as a jurisdiction as a whole. And there's always this discussion and this slight tension between the two, but we don't think that there's so much tension. We want to be open, but we want to make sure that we can make our voice heard. And so, and that comes back to the communication that you would have seen of January, which basically has three main pillars. One is strengthening the international role of the euro. This is where the biggest overlap is from what we just heard by the ECB. But then we realized, for example, in the Iran context, that it's not only the dollar, but it's also the financial infrastructure. Now, SWIFT, for example, the messaging services for all transactions, it was something that was very clear in this context that no transaction were able anymore with Iran because just at least more difficult because the messaging service was not provided anymore by SWIFT, for example. And so we need to look into that too. And finally, and ask the question, the broader context is as sanctions become more and more financial sanctions, using financial infrastructure, using the dollar. That's why I think there's a third strand that we need to look into is about sanctions. So our own sanctions potentially, but also how to counter sanctions from third jurisdictions. Obviously in the financial sector, we had them particularly in the US, but we don't know in future could also be others. So what the strategy is on the role of the euro? I think what is key is that we are attractive as the eurozone, and attractive means that we need really to try to finalize the missing pieces of the banking union. Obviously, we have a lot of difficult issues still outstanding, always the most difficult ones. But at the end of the day, I think we really, if you want to be, a worldwide player, we need to. There's no way around it. We need to finalize the banking union and be really the player that we want to be. But the next one, which is very difficult, obviously, but also essential, is the capital markets union. I mean, we need deeper and more liquid capital markets in Europe, and for that, obviously, we have tried to push, but there are a few key issues that we never really managed to address, which is taxation in particular, and partly civil law, which is really important if you want to have a European base for that. But we keep on trying. And then what is also important is obviously digital and green, this twin transition. Here, I think we're making good progress. It's also been mentioned by the ECB, especially also on green finance. We're going to come to that later. We're basically one of the main issuers of green bonds at the member state level, but will be the same and even more when we will come out with the issuances under New Generation EU. And then obviously we need to be more attractive, and we reach out to the outside world and explain the advantages of the euro. We've seen that works for some, especially around us, but not all of them, even not all of them around us. There's no point in reaching out to South America. They're clearly dollarized. There's no point. I think we need to look at those that are economically relatively close to us as Europeans. So the next generation EU has been mentioned also by the ECB. I think this is one of the big steps forward. It's for the first time that we would have then issuances at the European level, which will then be transferred into also grants to some member states that are in need. We started off with SURE already, that's been mentioned and worked well. This for unemployment, and we had a lot of appetite by non-European investors. And now, obviously, the big one is this one, and I'm sure that that will work well as well. The objective is also to have 30%, obviously, as green bonds. That will give a further push for green bonds, and I think that's really a sea change. Obviously, some criticize it as being too small, but I think it's still a significant step. So it's an 800 billion program, 150 billion per year. I think that's not to be neglected. So that's another big element, I think, in making the EU and indirectly, obviously, the euro more attractive to outside investors, for country investors. So if you look at the green transition here, it's clear that also because the US was partly absent during the last years, that obviously may change now. There is a clear front-runner status by the EU and the member states in issuing green bonds, and that means that also most green bonds were obviously issued in the euro, and I think we can and should build on that. And this is a good way forward. We've done a good chance because we have a bit of a first move advantage here. Digital euro has been mentioned as well. It's important that, that Europe looks at this as well very seriously. Obviously, as you mentioned, it will depend very much on what exactly the design features would be, wholesale, retail, will it only replace cash? Would it be able to fuel smart contracts or whatever in the future? What will be the role of the banks? So there are a lot of things that I think would need to be looked at, but we think that's important that we, that's obviously over the ECB, but we'll, I think we're in close contact, is to see what we can do to have potentially this digital euro project going forward. I think overall for the national euro, we mentioned that, but even more also for our own autonomy, also being faced with other third country operators that might want to move into the space. So quickly, the euro and the energy markets. Obviously, we already see green, but at the moment, obviously, energy. There are also other issues like gas. Gas is obviously still transitional, but will still play a certain role. And what we're trying to see is whether we can have more euro-denominated exchanges and trade activity, gas hubs here in the EU. At the moment, it seems that the clear front runner is Amsterdam. Obviously, there's also one in Vienna. It would be good to give a little boost to Vienna too, but as it seems for the moment, it's really Amsterdam that's heading here in the EU context. The same also maybe for hydrogen, which is a new element that will come up. That's also for climate, also EU economy. So even there, we see whether we try to see whether our colleagues in DG Energy, whether we can have, we can help there also in terms of increased trading in the EU. Now, market infrastructure is now the second one, which I think is closely linked. I mentioned that already. I mean, one of the big issues, for example, is clearing. We have it now, especially in London, the CCPs, and this has been here for a very long time. And the question is, obviously, there's a working group looking into this to see to what extent we can transfer this back to the EU with all the advantages and disadvantages, obviously, because we want to have a liquid and functioning market. At the same time, want to make sure that if there is a crisis, we have the right, or there is the right reaction, because obviously then the question is who will, because we have a lot of obviously EU-denominated derivatives that are traded and cleared, particularly in London. So if there's a problem, who's going to step in and how would that work? It's a thing that we need to look into, I think, very closely. But that's just one example. There are others as well. So financial market infrastructure that to some extent can be used, obviously, also to influence policy. And the question is, how do we react to that? That's is that a question of business continuity at some point? How can we make sure there's under the flow of essential financial services? And we had at some point, luckily that's over now, sanctions against judges at the ICC in The Hague, so the International Criminal Court, and they were, for example, denied basic services in banking, for example. So how do you react to that? But okay, luckily this is one problem less, because these sanctions have been stopped in the meantime. So the last bit, just very quickly, because it's not the main element here in this discussion, but it's also important, is sanctions. On the one hand, we have our own sanctions, and they're not necessarily always implemented very coherently. So I think we need to be, if you want to be a serious player at the national stage, want to make sure that if sanctions are decided, they also follow through by the whole of the EU and by all member states. And I think as a Commission, we want to have a bigger role here, and we will step up our efforts now to make sure that this is actually the case. On the other hand, I think international cooperation convergence now is improving again, especially with the US on a lot of third countries, and that I think that works very well. That's very good. But we still need to see to what extent we want to have some more tools in order to counter extraterritorial sanctions that will come from third countries. When I mentioned Nord Stream 2 is obviously still an issue. There might be others. We have a blocking statute, you know that, but this blocking statute doesn't always deliver. And it's as long as it's broad, it's non-financial service, but it also concerns some financial service infrastructure. And the question is to what extent we can make this a better tool overall. So that's just to conclude. So, and it's overall, I think, open city autonomy. It's, as I said, it's broader than financial services, but it's also important in financial services. And we think that we need to look at these three elements together in financial services, because if you want to be stronger in a way to try to fence off sanctions by third countries, that will only work if you're less vulnerable on some key issues, including in our own financial infrastructure. But we all know that this is a kind of step-by-step approach. It will take a long time. It's a mixture, as we said, of things that we need to do to be attractive as a eurozone ourselves, and there are little steps that can be done. But at the end of the day, it's also the market that will decide which currencies they're going to use, and so we can just try to help. So it's I think it's a long haul project, but that is worth pursuing. Thank you.
Thank you, Klaus. We now immediately switch over to Harold.
Well, thank you so much, Ernest. It's a great pleasure being with you and being with SUERF. And this is the 20th edition of a report on the international role of the euro. And in a sense, it's a very familiar story. And fundamentally, the theme has been there consistently for the last 20 years. That is that the dollar is at the center of the world financial and monetary system, but the euro is definitely the number two. And it sounds a bit to me like this famous advertisement from the car rental firm Avis in the 1960s. We're number two, we try harder. So the number one firm, Hertz, could make mistakes all the time, but Avis, as number two, couldn't make any mistakes. There are long periods of stability. And basically, the last 50 years have been a period of stability. And in a sense, also the report that you've been doing for 20 years, it was anticipated in the 1970s. There were really nice IMF reports on the international role of the yen and the international role of the Deutschmark. And they pointed out always that the dollar was going to be at the center. But at that time, there were strong reasons why both Japan and Germany didn't want their currencies to take on a major international role. But you can also see that this story has dramatic moments of discontinuities. And obviously, in the interwar period, the rise and fall of sterling, sterling falls after the First World War, then rises again in the Great Depression with a renationalization of the currency world. The 1970s is another of these moments of great turbulence and a lot of thinking about what an international reserve is and how the international monetary system is going to develop. And the 1970s, you can see, I think, also that the dollar starts off with a lower role in the 1970s, rises to the late 1970s, and then gets into a crisis in 1977. There's a lot of interest now in the 1970s, and I think it's worth going back a little bit into the story of the 1970s, because we have, I think, one moment, one indication that is quite crucial, that we're no longer in what Mervyn King used to call the nice world. Mervyn King, I think it was Mervyn King, who coined this acronym in the 2000s, non-inflationary continuing expansion. Other people had different versions of that. Sometimes John Taylor liked to play with nearly international competitive equilibrium. for nice, but we're not really in a nice world anymore. And what's particularly not nice about the current world is that for the first time, really, there are really big differences in observed inflation and to some extent in expected inflation in the major international centers and the major international currencies. The most recent figures for CPI, the headline index that people look at, for the euro area was just over 2%, and I think there's nothing to worry about that. But for the United States, it's just over 5%, and there is something to worry about that. And the story of worrying about that is a story of what happens in the late 1970s with a rapid phase of dollar devaluation, a reduced willingness of countries to hold the dollar as reserves, and thinking about new international monetary options. Discussions at the IMF of a substitution account. The dollar was really resilient at that time, but there were some fundamental mistakes that were made in the 1970s by the US monetary authorities and the political authorities that look as if they have an implication for today. Let me just briefly talk about those mistakes under three headings. In the 1970s, the initial reaction to the increase in commodity and oil prices in the early 1970s, in 1971 and 72, but then particularly to the radical break in 1973 when this became highly politicized with the OPEC increases. The initial reaction was to say that this was just a temporary phenomenon and it didn't reflect anything to do with inflation. And we are today, I think, in the United States particularly, in danger of thinking that short-term supply shocks are just that, they're just short-term supply shocks. But if we're thinking, for instance, about the shortages of chips, the story of Chipageddon that has produced big spikes in all kinds of areas, in automobiles, refrigerators, a whole range of consumer items depend on chips. What that is a price signal telling us that we're moving into a more electrically connected world, a more IT connected world, that we will need a lot more chip capacity. And in the end, the producers will react to those price signals and build more factories, and there will be more chip production. But it will take some time for that to happen. Excuse me, I can't stop that phone. The second danger was to say that you shouldn't respond. You shouldn't respond to that price increase by trying to adjust, but you should accommodate it. And it was that process of accommodation which was much more pronounced in the United States and in the United Kingdom and in Italy than it was in Germany, where the reaction was much more to make the adjustment. And the consequence was that Germany had lower inflation rates from the 1970s and became a more credible currency. And that's really what pushed this discussion about the greater international use of the Deutschmark. And the third policy mistake was that there was a belief that if you did enough stimulus, you could grow more quickly, and that would hold down the interest rates. So there was a kind of magical thinking. It's most neatly embodied in some growth models that Nicholas Kaldor in the UK prepared and that were deeply influential for the UK government in the 1970s on this course that brought UK inflation to over 25% by the middle of the decade. But it's in the United States as well. If you have growth, you should increase capacity. And in the way that Roy Harrod formulated it, increased growth would actually reduce the level of inflation. Well, that I think was magical thinking. It was illusory and not really appropriate. So are we in danger of that kind of moment happening again with this big divergence in inflation rates, with Europe looking very different to the United States? Slower recovery from the COVID crisis, but lower inflation rates as well. And I think that question relates very immediately to the question of the sustainability of government debt. And one of the things that has happened since 2008 is that debt management has become very much an obvious function of central banks everywhere, that they have to manage debt, and they do it for monetary policy reasons. But debt management can be unsustainable if you need to react quickly to a big threat of inflation. And so the threat, the danger of a looming version of the exit, the tapering tantrum in the early stages of the response to the global financial crisis is there again. And there's a question about what that poses, what risks that pose to financial stability in an era in which, as the paper makes very clear, there's a lot of funding that still takes place in dollars. What's going to happen to that? So the story, I think, is that the Euro and the ECB and the European Union and the Commission, then obviously as well, really have to prepare for a greater reserve role, a greater international role, not because it's something that they necessarily want to achieve, but because it's something that will be thrust on them by policy mistakes that are made somewhere else. In other words, they need to be like Avis and try harder to make themselves resilient in the face of this possible, even relatively likely shock. And what does that mean? Well, I think the implications have been stressed and they've been laid out clearly, that you need the development of the capital market, you need the full development of the banking union, but you also need, I think, a larger share of safe assets than you have with the relatively small start that has been generated by the Next Generation EU program. That's, I think, clearly a step in the right direction, but the world is going to look for a safe asset much more desperately if my kind of scenario is right, and we're dealing with big inflation differentials that will remain for some time. There will be a search for other currencies, and they may be the euro, but they may also be other currencies, the renminbi. They may also be private sector currencies. And if you look, for instance, to South America or to Central Asia, there's a lot of interest there, not in other officially issued currencies, but in blockchain currencies, privately issued currencies. And unlike in the 1970s, the possibility of private competition, private currency competition, is a much more realistic one now, given the technical change and the opportunities that IT and AI give to the world. So in a sense, we should learn from the 1970s, but we should also see that there are more possibilities, many, many more possibilities in the world of the 2020s. And you should really follow the Avis advice and try harder all the time. Thank you.
Thank you very much, Harold. I now hand over to Bob McCauley for a perspective of US dollar, euro versus renminbi. Bob, over to you.
Thank you, Ernest, for this opportunity to discuss a marvelous report. This year's did not disappoint. It's really Christmas in June, and I will force myself to say some critical things, but it's against that backdrop. So my topic is challenging the euro-dollar opoly, the RMB. How's it doing? So first of all, some suggestions for the report, then a word on the RMB in the foreign exchange market, the RMB in the global bond market, a step back perspective on the RMB, a case of lopsided rather than balanced internationalization, and finally a question, and I guess it's already been answered this afternoon, do we now have two jurisdictions promoting currency internationalization? So the report could improve its reporting and updating of FX turnover by currency. It may seem like just a matter of taste, but I find a statement like the dollar represents 44% of all currencies involved in the foreign exchange market not as helpful, not as pointed as the statement the dollar is on one side of 88% of trades in the foreign exchange market. Obviously, they're the same statement at some level, but one, I think, engages in a way the other one doesn't. The report could do a slightly better job of updating the turnover. The report relies on the 2019 triennial survey shares, but major foreign exchange committees report every 6 months. The last one was for October 2020. Oddly enough, there's no such surveys in the euro area, which may account for the ECB not engaging with this particular source. But once you've got through London, New York, Hong Kong, Singapore, Tokyo, Sydney, Shanghai, and Toronto, you have a pretty good idea of what's going on in the world of foreign exchange. So what we know is that from those reports is that turnover fell about 4% in October 2020 relative to April 2019. And in particular, London was down 10%, Hong Kong down 11%, Singapore down 3% in turnover, while New York was up 15%, Tokyo up 7%, Sydney up 17%, Canada up a striking 18%. So things have been moving. Not clear what the story is. These don't match one-to-one to inoculations, for instance, say the least. What about turnover by currency? Well, in the most active center, RMB trading actually rose from 78 billion a day to 85 billion a day, even as overall trading fell by 10%. Overall, in these 5 centers, the share of the RMB went up to 4.2%. Although you can see from this graph that the RMB is still quite regional in trading, with a wide dispersion of how much of the local foreign exchange market is devoted, as it were, to trading the RMB, with almost 20% of Hong Kong's trades in the RMB and London at 2.5%. So the report could reconsider measuring key currency anchors. The chart 1 and box 1 depend on Iltsetsky, Reinhardt, and Rogoff, who sort currencies into zones on a sort of winner-take-all basis, of which key currency has the lowest variance, as it were, against the given currency. But it seems to me that you're losing information if you go this winner-take-all route, and in particular at the edges of the euro area, the ruble, the Turkish lira tend to be intermediate in their response to euro dollar movements. So why not go back? It was done in a previous report to following Haldane and Hall and Franco and Way, essentially decomposing currency movements into those associated with dollar euro and idiosyncratic movements, and assigning currencies to the dollar or euro zones accordingly with sort of a proportional representation. So technically, I think this is a case of errors in independent variable, and the consequence of that usually is that there's the estimated coefficient on the currency alignment variable is biased towards 0. Doubtless not fatal, but room for improvement. So this approach, let's consider two currencies, sterling and Singapore dollar. Both of those tend to be very solidly intermediate between dollar and euro, at least in these sample periods. So when the sterling effective exchange rate, the red line on the left, is sort of level for substantial periods of time, that means that sterling is sort of moving between the dollar and euro in the way suggested by the trade share, something like 2/3 weight on the euro and 1/3 weight on the United States. And that's not a matter of Bank of England or UK Treasury policy. It's just the way things work given monetary policy and the connectedness of the UK economy. Things are much more policy driven on the right-hand side with the Sing dollar. Notice a very tight range there for the effective exchange rate. And essentially, in a Taylor rule type world, Singapore controls the effective exchange rate in a basket band crawl, BBC, in order to get its inflation objective of around 2% a year. But either of those properly analyzed, neither of those can be properly analyzed if you want to assign the currency to one zone or another. I mean, the British pound is no more anchored to the euro than the Sing dollar is to the United States dollar. So measuring FX reserve composition by currency is also problematic. Box 1 depends on the IMF staff compilations of FX reserve composition by currency. Despite the studies having 9 authors, the reliability of this study remains to be demonstrated. And just as a case in point, the Riksbank gives 2 FX compositions. One of them is by country, meaning by instrument, and the other one is by FX exposure. And so apparently based on the former, the chart 13, the team of 9 comes to the conclusion that the Riksbank reserves are about half dollars and a third euros. Whereas if you pay attention to what the Riksbank is telling you, I think you come to the conclusion quite sharply different, that the dollar share is 10% and the euro share 50%. How many more differences like that can one find? I don't know. So back to RMB internationalization and moving from the foreign exchange market to the global bond market. Clearly, a story for the past several years has been large flows into government bonds in China. Things have loosened up, inflows, hedging more permitted, if not completely unconstrained, and the major bond index providers have recognized this sort of institutional progress, and so index money has flowed along with yield-seeking investors into the market in China. Foreign holdings have hit more than 10% of the local government bond market. There is a question of whether the current tax exemption for foreign investors will be renewed in November at its current expiration date. But if you step back from this, what you see is another asymmetry where the progress of internationalization has been much more noticeable on the inflow side, on the rest of the world holding RMB, than on sort of the outflows or for borrowing, critically third country borrowing in RMB. So you can see this in the balance sheet, the international balance sheet of China, just focusing on banks here where the data is quite complete these days. Banks in China have external assets at the end of last year of $1.4 trillion equivalent. They have external liabilities just about the same, 1.5 trillion. And if you look at the currency composition of that, you see 2 things. First, that the RMB plays a second fiddle to the US dollar, whichever side you look on. And also very noticeably that the RMB's role is asymmetric. It's much more on the liability side. So the RMB has been more used in international banking as a deposit currency than a borrowing currency. The rest of the world is happy to take RMB deposits, yielding something like 3%, but so far has been less willing to borrow those same RMB at the same sort of interest rate. The easy contrast is to the United States, where the dollar dominates on both sides and the position is fairly symmetric. So even if you focus, and there's marvelous work done by academics shown in this cover here in the lower left, even the Chinese policy banks, these 100 loans that the academics have collected are mostly from Exim and China Development Bank, and their 2 emerging market governments, mostly in Africa and Latin America. And it turns out that most of even the where you're lending often to kind of a low-rated government borrower who you think would be open to suggestions as to the currency of denomination, one finds that most of the lending is in dollars and relatively small slice in RMB. So the asymmetry persists even when one focuses on the sort of official lending by the Chinese policy banks, much of it in pursuit of the Belt and Road Initiative. So that brings me to my version of the long history in that marvelous last graph that Harold pulled up for us. This is an adaptation of the work of Benjamin Cohen, a book called Currency Statecraft. And I think I have found myself arguing, so I've moved some things around here, but I think the spirit of his work is still here, that there's three basic policies. You can resist internationalization, be neutral towards it, or promote it. And this all happens in the three phases of man, or in this case, the three phases of currency internationalization. And yes, as Harold said, resistance was the norm among the German and Japanese authorities, and might say the Chinese authorities in the 50s, 60s, for Japan through the 70s, for China probably through the aughts. The neutrality is well represented sort of in that center box by the euro area. And then there was the promotion as a young international currency by China, which started some 10 years ago, by Japan in the 1990s. Cohen has the US coded sort of one way most of the time and another way on occasion. Can argue about that. Catherine Schenk's work on the decline of sterling is represented there in the bottom row in the 50s, sort of resistance as Cohen reports it, and reinforcing the decline later in the 60s and 70s, and a sort of relaxed pose of semi-neutrality for the Japanese authorities in more recent time, and the UK authorities, arguably since got rid of the capital controls in 1979. So that leaves us with, yes, it looks like we have two promoters, and quite apart from the conversation we've already had this afternoon. On the next slide, I just have a series of exhibits that take you in the direction of policy having changed from the original clearly enunciated ECB, neither promote nor discourage, to what now looks like a cautious, careful, multilateral, cooperative, but still promotion. That's the new European policy. And obviously there's more that could be cited. One of the striking exhibits is Exhibit C, which is a pair of lawyers writing on sanctions, and they thank the ECB legal department for funding support, just in case you think this is just Brussels that's at work here. So with that, I conclude, and again, thank you very much, Ernest, for the kind invitation.
Thank you, Bob. I would invite all of you, starting with Hans-Joachim and Arnaud, to comment on each other's comments.
On the discussion by Harold, I would be much less concerned about inflation than he was. I think we have all learned from the 70s, and we have some fundamental changes since the 70s. I would say the most important is probably the introduction of inflation targets. We have anchors for inflation. Second, we got rid of indexation. Wage behavior is much more well-behaving. We don't see risks of second-round effects in that respect. And third, we have a better understanding of the role of inflation expectations. And I think central banks pay much more attention to that. So I would be personally less concerned. Certainly, we are monitoring this. Second, I very much like the concept of try harder. I think that's really what we have to do in Europe if we want to have a chance to promote the euro as a global currency. I mean, if I look at the key components of what we need for a global currency, I would see resilience and economic performance. I would see the infrastructure, and I would see the market depth. And I think on resilience, we make good progress with the NGU, but we know it's just a temporary facility. The question is, are governments prepared to keep this as a permanent instrument? But at the same time, the question is, will the NGU funds be used for reforms? I mean, we know the euro area is vulnerable because of its weakest parts are being vulnerable. Will these countries adjust to this? And third, we know we haven't solved the bank sovereign nexus in the euro area. And I'm afraid we see little momentum on banking union. I mean, there we really have to try harder. On CMU, we advance, but I fear that the issues are so technical and some of the biggest challenges are not being addressed by the current initiatives. And also here, we probably have to try harder. And finally, on market depth, I think comments were made on safe assets. But of course, we also have to make sure that we can improve the. I mean, I think Arnaud showed the slide of the decline in highly rated euro area bonds, which hopefully can be reversed in the future by having upgrades again. And the third point, very quickly, I would tend to agree with the very interesting slide by Bob on the, let's say, approach towards the euro. There is certainly a somewhat more positive thinking inside the euro system on the international role. We started with this in 2019 in our report, where we had considerations on the benefits and costs of the international role of the euro. And you know, at the beginning, it was very much driven by the thinking of the Bundesbank, concerns about monetary aggregates, stability of monetary aggregates. But I think we are much more convinced that a stronger international role gives you more autonomy and reinforces the monetary policy transmission, because you have a stronger impact on the rest of the world. So I would share your view that the ECB has developed here over time. So Arnaud, I leave the difficult issues now to you. I'm sorry for that.
These are not difficult issues. These are great points, in fact. And I would say, I mean, in any case, I mean, Bob knows that we will continue to discuss this bilaterally in the next month. But I mean, I agree with them. No, we do the best that we can do on measuring FX turnover. Probably we don't. If we look at the BIS triangle survey data of 2 years ago. To be fair, there is a bit of updated data in the report. We look at data from CLS on settlements, and those are available monthly. So that it's probably not as good as the one that you suggested. You probably should look at the ones that you. It's a great idea. Is the how do you call it, the winner takes all approach of Carmen Reinhardt, Ken Rogoff, and Ethan Izeki the best one to measure anchoring? Probably it's not. No, it's just tough to measure de facto anchoring. The Frankel and Way method that you use, we use as well, as you know, it's still an estimate. You can always argue whether you do justice to all the idiosyncrasies of the data, or how you obtain time varying estimate is hard. So I wonder whether we should just go back to the URE measurement rather than de facto. But okay, that's something we'll discuss together, I guess. And your last point on the data by Yanku et al. So to me, the key lesson is to let's use the McCauley and Ito data instead. And why don't we just update them together to make sure that we can use it for next year's report as well? I think that's the. But okay, I would have loved to talk about your metrics about the different policies about internationalization, because I found it really great, and you should probably put them in a paper or something so that people can refer to it and think about it a bit more deeply, because that's really enlightening. And before closing, I just want to say something to what Harold James said. I mean, I really love the discussion about the 70s and the carted dollar and the monetary policy mistakes which were made back then. And there's something that I learned usually a lot from Harold's op-ed and writing. And what I learned now is that geniuses can fail, because I didn't know that Nick Galdor and Roy Harrod were thinking that if you were to push growth, interest rate would fall miraculously. That's something which is interesting. And perhaps as central bankers, we should be careful in listening to the geniuses that we talk to, and give good advice on monetary policy and what we should do at the current juncture. And even them could fail in the 70s, and there's no reason why it couldn't fail right now. Thank you.
Thank you, Arnaud. Klaus, do you want to react to some of the points?
On the try harder point, and we do what we can, but at the end of the day, for the big issues like banking union, capital markets union, and also the future of non-derivation EU, it's the member states, and it will depend on whether we get this commitment that we need from the different governments to go forward with that. We're trying what we can, but obviously it will depend on the member states. Thank you.
Thank you. Harold, you want to have a last word?
Yes, I mean, I think indeed inflation targeting was a fantastic improvement, but inflation targeting wouldn't have worked if you'd introduced it in the late 70s or the early 80s in a very, very unstable world in which relative prices are moving in different directions. And my fear is that we're in exactly one of those moments, so that we're seeing some prices really going down dramatically, but other prices really increasing in a equally dramatic way. And that kind of diversity is not really well captured by these consumption baskets. So I would urge a bit of caution on the consumption basket approach. Thank you.
Thank you, Harold. This concludes our webinar. Let me thank our speakers for sharing your insights and all of you for your interest. Thanks again. Bye-bye and take care.
Bye-bye.
Thank you.